Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Wednesday, the 29th of November, Bull versus Bear webinar. Steve Miley here on the call for trade day. Welcome, everyone. We're going to go through our usual regular run through in here today. What we've had, what we've got coming up, and looking for the major news wires, what's the fundamentals, macroeconomic, geopolitical aspects, the technical aspects, what's going on in the charts, where are the trading opportunities. So basically, as we've been looking for, and I don't want to, you got to beat your own drum every now and then, right? So we've been talking about maybe this pivot from the Fed, right? We've been talking about maybe the Fed starting to price, or the market starting to price in maybe cuts coming a little earlier, and that being good for stocks. Well, it's all starting to come through. I've been talking about this. You guys have come on the webinar recently. No, I've been mentioning for the last, I don't know, 2, 3, 4 weeks now, keeping an eye on this Fed Watch tool, right? And watching, the risk that we're going to get an earlier rate cut than the market was pricing. Remember, the market was pricing in like May/June. We're going to look at that and see how that's all starting to come to fruition now. So first of all, let's see what one of the main drivers were, right? So one of the main drivers, remember, we had Waller was on the wires. I think it was the day before. It was Monday, right? Or Tuesday morning, maybe. It was Monday, but we didn't really get the reaction. It was kind of a slow reaction to that. And but certainly some bond markets. And then we had the positive bond market auction and Waller. And now if we go and look at our Hawk Dove sheet. So for those of you who haven't seen this before, this is on the Trade Day site. I share it with you. I would suggest you bookmark this on the Hawk Dove sheet. So this shows you the Hawks on there. This does need a little bit of updating. I'm going to go in and do this today because some of these have slightly shifted around. I'll be quite frank. I draw this data courtesy of ITC Markets. Okay, so that's a research group. And this is their Hawk Dove sheet in here. So I'm only drawing it from here for you guys. But what we'll see in here is some of these, but they're not really moved around. It's that some of them are no longer voting members, etc. So, but it's pretty much the same. So we go to our Hawk Dove sheet in here. You'll see that Waller is down here, okay, and Waller's a hawk. It's down definitely in the more hawkish side, and is a voter as well, which is fairly significant. And Waller definitely shifted on Monday to a more dovish stance, okay, and that shift to a more dovish stance certainly having an impact into markets, seeing bonds, and also the positive bond auction we saw on Monday seen bonds go significantly higher. On top of that, in here, and remember, Bill Ackman was kind of quite bearish on bonds only a few months ago in here. Bill Ackman now is joined the Steve Miley Club. Okay, so Ackman in here saying, where is he? Where's I've got these? Actually, there's an article from here. It is Bill Ackman. Bets Fed will cut interest rates as soon as the first quarter, which is what I've been talking about, maybe coming in the March reading. He said he observes evidence of a weakening economy. Investors see risk of hard landing if Fed doesn't cut. So, yeah, and that's starting to get priced in. So I'm going to jump around a lot in here. But, December, we're still looking at the next meeting. It's only a couple of weeks' time. Unchanged. And remember, the Fed go on their blackout period. I've been harping on about this. We've only got this week. So the next meeting is the 12th, 13th of December. We only have this week. And then from this Saturday, the 2nd, the Fed are on their blackout period. Okay, so no Fed speakers. So we've only got this week for Fed speakers. There's only 3 more days, Wednesday, Thursday, Friday. And Powell is speaking on Friday. That could be super important. It's right at the end of the week. And so, and then not early in the morning as well. I think it's around lunchtime. We looked at it before, but we'll take a closer look at it on Friday. But I think that could be super important, particularly as Waller, who's a hawk, shifting slightly more dovish in here. And what it's meant for if we go back to the tool in here, so December was still nailed on for unchanged, and for January meeting as well. But now we get to March. Look at this creeping up. And I said, I thought this would creep up towards 50. Look, we're already at 39.8. So you add this with this tiny bit over here as well. We're over 40%, nearly 41% chance of a rate cut now as early as March, and so that's really significantly increased. And by May now, we're pretty much nailed on. There's only a 26.9, so 27, just over 27% chance that we won't have rates lower by May. So, but now increasing bets that rate cut is going to come earlier. And that's what we've been talking about. And that has really been, and this is the other thing I've been talking to you guys about loads, So bonds went back high. 30-year bonds only went back up to the highs yesterday, right? Because remember, the longer end is looking at the economy. The short end is looking at the interest rate. The current interest rate is looking at the central bank. So 10 years after that good auction, they popped up higher yesterday through the recent highs. So we're going to new high prices, low yields. Similar, the 5-year even stronger, but it was all led by the short end. So the 5-year there, and look at the 2-year surging higher in here. And we'll go and take a look at the 2-year today. But importantly, getting up to and through these highs in here, reinforcing this uptrend that we have from the middle of October and reinforcing a higher price, lower yield basis. And if we go and jump to the, let me come off of that, to the 2-year in here, there you see it, boom. And not only through to yesterday, but look at today as well. This is today, so going still high. This is the 2-year note. It's on the March contract in here, ZTH4, if you want to go and take a look at it and monitor it. This is super important for equity indices. This is basically telling you that there's more and more chance of an interest rate cut coming sooner. The higher this goes, the more chance of an interest rate cut, and then that is a positive for the stock indices. So stock indices weren't particularly aggressively up yesterday, but I think they've got catching up to do. The bond market is now telling us we think interest rates cuts are coming. Now, remember, the reason maybe stocks are not rallying so strongly is why are those interest rate cuts kind of potentially becoming sooner? What is Ackman saying? Well, basically what they're saying is they're worried, look, as observed evidence of a weakening economy. He's worried, Bill Ackman, that we're going to get a slowdown and they're going to cut sooner because of the slowdown. That's kind of negative for stocks, yeah, but generally stocks are going to look initially, before we actually see the slowdown in earnest, stocks are going to look at, wow, okay, we're going to get an interest rate cut in here. We like that, okay? But it might mean that then eventually we go into a slowdown and stocks then suffer because of that. But initially, so I think you really have to be keeping an eye on this. I've been going on about this for a couple of weeks now, 2-3 weeks in here now, watching that level on the bonds on the 2-year. We've broken that level now. I think opens up a significant upside. And if you look at the equity indices, what happened really well? A dipped and bounced. We've had dip and bounce all since before Thanksgiving. We've gone completely sideways. Here's the S&P, and the same with the NASDAQ. In here, sideways since Thanksgiving. And if we go and take a look where we are now on there, okay, we're popping up to the top of the range and out of the top of the range in here overnight in here tonight because of that strong activity that we've seen overnight as well on that US 2-year, right? I really think this could be a significant update. We've got this high over here. Okay, that's up at 45.97.5. So up to and through there, I think is certainly possible. Through 4,600, it could be a really, given how sideways we've been, momentum kind of been flatlining down here. I think we could see this as part of like a bigger, this is kind of almost like a grinding up flag in here pattern, and there's real risk of an explosion higher over the next 2-3 days, and it could be topped off in here. Remember, we've got a lot of data with GDP today. Okay, I haven't gone to the calendar yet. GDP today, PCE tomorrow. Now remember, PCE is the Fed preferred inflation measure, and then Friday we've got PMI data, US and global PMI data, and we have Powell speaking. So we've got a whole set of data that could see, and a slight slowdown, right? The chances are if we see the data slightly negative, it's more likely to be good for stocks. Counterintuitive against what we understand or what we normally think. Why would slightly negative data? Well, slightly negative data will probably see the anticipation of more aggressive or sooner Fed rate cuts. Sooner Fed rate cuts, higher bond prices, lower bond yields, and that could be good for stocks because the stocks are initially going to look at, okay, the data's wobbling. As long as the data's not really bad, you don't want bad data. We want it to slightly worse data would actually see stocks significantly rally. So if you're a bull in here, you're looking for data to be almost in line or slightly worse than expected, and then that could take bond yields lower, okay, anticipation of a more dovish Fed, and then send stocks higher, even on slightly worse data. So watching out for that. So I do still think there's real potential. I mean, we're shooting higher already in here today, both there on the ES and on the, where's the NASDAQ in here? on the Nasdaq pushing higher as well, right? So and not quite up to the highs there. So I do think there's real risk for a significant upside in here. So let's go and take a look and jump now to the calendar. We do get that US GDP number. Yes, it is a big piece of data, and it is actually it's not too bad. Sometimes this data is very backward looking. This is the preliminary data for the third quarter. But remember, in here at the moment now, we're at the end of November, right? So this is data for the third quarter on data for Q3, preliminary data for Q3. Okay, so it is very, very backward looking. That's why GDP data, when we get it, even though it's really important data for the whole economy, it's more important for economists and traders because it's so backward looking. Preliminary data for Q3. Okay, so remember in here, Q3 is is July, August, September, right? We're now at the end of November. So this is data pertaining to July, August, September. So it's very, very old data. But nevertheless, we're going to keep an eye on it anyway, see if it's out of line, in line, etc. Okay, so that's the main focus today. Crude oil inventories, that's weekly data. We get that anyway. So, and then we've also got Mesta speaking. So watching out for Mesta. We go and take a look on our Hawk Dove sheet in here. Where's Mesta? Mesta in here and down towards the hawkish end. Is Mesta going to kind of echo what Waller was saying? You know, are we going to get similar comments? If so, we could see again anticipation of a more dovish Fed, higher bond prices, lower bond yields, and helping potentially stocks higher. Let's run through the rest of those 5 things today. Yeah, so bullish bets on maybe a more dovish Fed in here. Housing sectors drop a measure tightening US investment in Chinese technology. Okay, so that's a positive as well. London Metals Exchange, we don't really need to look at that. Israel latest, okay, seems like the ceasefire has been extended, but now entering its final 24 hours. And then we've got the US third quarter GDP, as we've already talked about in here, Mesta in here on the tapes. Will she echo what we got from Waller? Right, what else do I have for you? So Waller to Wall Street, Fed's on the turn in here. Charlie Munger died as well. Very sad. Great man. If you get a chance today to go and look at some quotes from Charlie Munger, there's some great stuff out there. 99 years old. So anyhow, but he had a good life. Don't worry about that. Fed's the policy pivot. The Fed's policy pivot, and Waller, a hawkish voice. Saying in here, look, a hawkish and influential voice at central bank, and be close in thinking of Powell clarifying that these. Rate hiking was over as current settings bear down inflation. So Waller, particularly a dovish shift there. There's the live chart in here for the 2-year note. 10-year bonds also going lower in yield in here. And stocks, up with treasuries in here. European stocks and US futures up. So there you go. And Bill Ackman agreeing with what I've been saying. So let's just have a quick look. I've kind of run through the charts in here. So the Nikkei was actually down. Hang Seng significantly down 2% in here this morning though. But European exchanges doing better in here. The UK FTSE slightly down actually, but the German DAX up nearly 1% and the French CAC just under 0.5%. And if we look on the overnights in here, we're up decently overnight, as we know, between 4 tenths and 5 tenths, 3 tenths and 5 tenths in the major indices up this morning. So all looking good, all looking positive. I don't think GDP will do too much, but I do think that there's real risk that we could go significantly higher today, given this kind of shift that we're seeing in the bond markets and the break high there in that US 2-year note. Any questions? Otherwise, I'm going to wrap it up. No questions, nothing coming through. Don't see anyone typing. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Take care, stay safe. I'll be back with you tomorrow with another bull versus bear webinar.